best in radio. It's all about what's next. Go to financialsurvivalnetwork.com and sign up for your free weekly newsletter. You'll also get 3 free reports. The Financial Survival Network. It's all about what's next.
And welcome. You're listening to the Financial Survival Network. It's Kerry, Lutz. It is Friday, November 7th, 2014. We are getting off to a bit of a late start. Apologize for that. But hey, late doesn't mean that we're not going to give you the best possible information, as we always try to do. With us now, Rick Ackerman, rickackerman.com. Make sure you go to his site. Get his free newsletter. It's chock full of great info. I read it daily. And Rick, welcome. And stuff is happening today, even though Friday's generally not the most interesting day for markets, right?
Somewhat less interesting than usual because the jobs figure came in exactly in the middle of the 235,000 over bet. So the market looks a little subdued today, but otherwise, we're living in interesting times. Kerry, and it's there every day in spades in the stock market.
Yeah, and gold today. All right, so everybody's saying gold, barbarous relic. Don't bother buying it. It's going no place but down. You, on the other hand, felt that it's pretty close to a bottom. Today, for no apparent reason, up $26. In light of what you could say is a pretty positive jobs number, if you believe the numbers, which I stopped believing them a long time ago. A guy who I know for probably 12 or 13 years, name of Paul Singer, head of a huge hedge fund called Elliott Management. If you follow these things, you can't help but see his name all over the place, or Elliott's. They helped Argentina go bust recently, has said that all of the numbers are fake. GDP, employment, inflation, and eventually confidence will be lost. And once you lose confidence in an economy, in a government, it's damn hard to get it back. And, hey, maybe it's so. I mean, what are your numbers telling you here, Rick?
Well, I'm eager to short virtually every rally target that I get, which in the case of the E-mini S&Ps means 2037.50. That's the December futures. We've been within 4 points of that today, so we're almost there. I'm leaving room for an overshoot to 2055. It's always with trepidation that you call the top, or try to call it, in a bull market that's now in its 6th year. But I just think the headwinds are too strong, and I'll trade the rallies, but each and every, what I call a hidden pivot target, I'm eager to get short.
Hey, just yesterday, dollar hits, breaks 88. All right, that's really the story of the rally of precious metals, right? If precious metals are doing good, it's real. If the dollar's breaking new highs, I mean, these are like 4 or 5 year highs, real hard for precious metals to make their case, isn't it?
Yeah, that's true. And I have been hugely bullish on the dollar. In fact, the dollar has more than fulfilled my expectations. And it leads me to wonder whether something that I put out there in some of the writing I did 20 years ago is actually starting to happen. That would be a short squeeze on the dollar. Because in effect, if you owe dollars, even as on your mortgage or in any other way, you're short the dollar. You want it to go down in value. You want inflation to happen so that you get to pay back what you owe in cheapened dollars. But the whole world is on the other side of that trade rate now, having borrowed dollars up the wazoo. And I think it's possible that we're going to get to the point where we see a short squeeze on the dollar. It would come essentially out of the fact that there's some crisis in the financial markets that makes it impossible for very short-term borrowers to to roll their loans as they always do. They would, in effect, have to settle up in cash. So that's obviously a very crisis-oriented scenario, but it begins somewhere, and it might begin with the very strong, the relentless strength we've seen in the dollar.
Yeah, and that could disrupt all the carry trades taking place, like in the yen and in the euro, and you could really have a major crisis. And the one scenario that I always heard, that I always kind of agreed with, is that everything else would go down the drain before the dollar. And this scenario that's playing out indeed looks that way, because the dollar is the basis of everything, all the world's financial instruments, except for gold and silver. So it's like, to me, it's like that light bulb. You ever notice the old incandescent light bulbs? They just really glowed brightest right before they burned out, and that could very well be the case with the dollar.
There's a trade there, Kerry, by the way, and this is something I have been really hawking aggressively in my newsletter. Some of my readers, those who follow the letter, may have caught a piece that I did a few weeks ago under the headline "Inflation, Deflation, and Our Very Confident Bet in T-Bonds." I think that being long the long-term bonds, preferably by way of Treasury Strips, is the no-brainer investment of the decade. The popular wisdom is that, interest rates can only go up simply because the federal funds rate is near zero. And that's a mistake, though, because the federal funds rate is a rigged administered rate, and Treasury paper essentially reflects market conditions. So we're going to have a day when everybody in the world, for reasons of financial panic or recession in Europe or some geopolitical crisis, they are all going to flock to the quote-unquote safety of Treasury paper. So that as powerful a rally as we've had in the bonds, I think this is just a warm-up. You're going to see prices, if you're on these strips, and the further out you go on maturity, the more leverage you get in certain vehicles trading the bull side of Treasury paper. So you have potential capital gains there of over 30% if we test the interest rate lows of 2012. And the same thing holds true for the munis market, which is also going nuts. So as far as the bond rally, you ain't seen nothing yet, and I think it's just begging to be bought. It's also a great hedge against any long positions you want to hold in gold, because if we get inflation, the gold will go up. But in this case, it might be the best of both worlds. We're seeing a rally in gold and a rally in treasuries. But I would urge your listeners to consider just buying long-term Treasury Strips, which are a non-interest paying vehicle. You simply buy it discounted to par. It really is the no-brainer investment of the last decade.
Mm-hmm. And I got a question for you also, Rick, that maybe you can help with. A lot of you out there have asked me this question because a lot of you out there are well invested in the stock market, and you're worried that if there's a sudden dip in the market, like 30-40%, man, there go all your profits, but there goes a lot of your wealth as well. And the question is this, Rick: how do you properly insure your stock holdings against these sudden, violent declines? Is there a way to do this inexpensively and safely?
You almost seem to be implying covered rights or buying puts as the market goes up. But trust me, those puts, I've been an options trader for 4 years, 12 of them on the floor of the Pacific Exchange, and I can tell you that they're very knowledgeably priced. So if you're going to buy insurance through owning put options, you're going to pay for it. It's not going to be any bargain. I would suggest really that you do the hedging in your portfolio. And again, the best hedge I can think of is this play in long-term treasuries, because if the market falls apart, you bet you're going to see a panic of money flying into Treasury paper. So I would do the hedge that way rather than go out on a limb paying put premium, which if you've been doing that all along for the last 5+ years, it would have had a very, very significant impact on your bottom line. Negative impact.
Negative. So you can't buy like out of the money puts and hope to protect yourself. You're telling me here, there's no cheap way to do this strategically to really cover yourself.
There is. I mean, we do options trades all the time at Rick's Picks. I put out strategies in real time and over longer periods. And I tell my subscribers that whatever options they're buying, they should price them at its theoretical value of zero. I consider options as having zero value. So whatever you pay for them, you've overpaid. However, if you're willing to do
that sounds like my ex-wife. Yeah.
Anyway, if you're willing to do a little work, yes, you can hedge essentially for free. And the way you do that, I mentioned the 203,750 target in the E-mini S&P. So if you take a corresponding optionable vehicle like the diamonds, DIA is a symbol, and you buy puts when the diamonds are hitting a rally target, and we used one this morning that got within a penny of that target. So what you do is you buy puts on a rally target, and when the pullback that you're expecting happens, you sell puts at a lower strike for the same amount that you paid for the ones you bought initially. So you essentially put on a free vertical bear spread.
Right, you're in and out for free.
Right, and that's what we do with almost all of our options plays. I'm always looking to be in at no cost. Even what I call a Friday jackpot bet, we leverage weekly options that are expiring that day. We basically play against them. We look for the first move of the day is usually a head fake or a foot fake. It goes opposite whatever is going to happen later in the day. And we found that we bought options in Netflix. Some of my subscribers reported getting options in Netflix. These were 455 strike puts that one day that went to $5.80. So but they bought them as cheap as a dime. Wow. So anyway, the idea of it really is to time your options trade so you essentially get riskless vertical put spreads if you want to hedge a portfolio. But it's labor intensive, and you have to pay close attention to these hidden pivot targets that help us at Rick's Picks do that.
All right. And hey, when we return, more about where the stock market's heading, gold and silver, and what is next on the Financial Survival Network.
FSN Radio. It's all about what's next.
Every week the show is growing. Would you like to be a part of it? Then go to clubfsn.com and help support us with $1, $2, $5, or $10 a month and get a host of premium content with newsletters dropped into your mailbox, free books, private audio clips, webinars, and much more. Then join clubfsn.com. If you want to get ahead of the trend and ensure your family's financial security before it's too late, go to clubfsn.com and sign up.
The Financial Survival Network. It's all about what's next.
And if you're just joining us, you're on the Financial Survival Network, and we are talking with Rick Ackerman of Rick's Picks. You'll find him on rickackerman.com. Sign up for his free newsletter, invaluable information, and he'll give you more information later about how to subscribe, free offers. And Rick, so like the thing is about options and futures and that type of thing. If you're like me, you're put off by them. You're nervous about them. You're never really sure you're getting a good deal. What are some like rules to buying options that you live by?
Well, I think you need to time it perfectly. The more negative rules than positive rules. One rule, it's rule number one, is never, ever, ever buy an option, a naked option for a straight directional bet. And that means even I'll put out something in my own newsletter. Price line will be trading at one price, and I'll say I think this stock looks like it's about to fall $150. Even then, you're not going to make money if you buy put options. You need to hit it exactly right. And people get the idea that if they go out further in time, their options will have a better chance of producing a profit. The opposite is true. Time is your enemy. It works against you when you buy options. So a good rule of thumb is don't buy an option unless you think it's going to be profitable. It's going to go in the black within about 15 to 30 minutes. So forget about going 3 months out. You shouldn't even be thinking about buying an option unless you're catching a swing high or a swing low. Because otherwise, in 40 years, Kerry, I haven't met a single person who has made money buying options just because he felt bullish or bearish at a particular time. You absolutely can't win on a straight directional bet buying a naked put or a naked call. They are too knowledgeably priced.
Yeah, and leaps. What about leaps?
Leaps is even worse. Leaps are essentially very long-term options, and as I just said, the further out in time you go, the more you stack the deck against yourself. Leaps work fine if you're selling and you're covered writing them against stock you own or whatever, but don't think that you can get an edge simply by buying something that's expiring in a year and a half, and you think, well, it's got a year and a half to go, whatever your expectation is, way up or way down. The leaps are priced to take that into account. When you buy an option or a leap, you're basically saying this stock has behaved in a certain way, for the last 5 years, but I'm going to buy these leaps at a time when something anomalous happens, when the stock's volatility radically changes. And if you think you can win on that bet, then I've got a bridge to sell it.
So it's really stacked against you, the individual. When you get down to it, what about selling covered calls and that type of thing? Does that make any sense?
Well, it does in a steadily rising market. It's never rising quite enough that the vehicle on which you've sold options exceeds the strike price. It's a good strategy to increase your yield. So that's not too bad. That's certainly not buying all the money in options is made on the short side, or let's say the easiest money is made on the short side by doing covered writes or by selling naked straddles or this or that. And of course, the regulators would make you believe that everybody, when you hear that word naked short or naked short this or that, it's like a lot of oohing and ahhing as though it's really dangerous. But statistically speaking, it's a lot less risky to sell naked options, a lot less risky on average over time to sell naked options, naked straddles, naked puts, naked calls, than it is to buy them. The losers are all on the buy side. And although if you're constantly a seller of straddles, yes, periodically there's going to be some sort of move where they're going to carry the bodies out of naked straddle sellers. They're dead in the water. But most of the time, those guys just make money.
Interesting. So, yeah. So it's kind of like the casinos in Vegas. They don't build those places for winners, and they don't create those those options for winners either. For the most part, when you're talking about just buying them, like you say, directionally. Yeah.
Well, the some of your craps bets are as close to true odds as you're going to find in a casino. You'll have better odds at the craps table than you do buying puts and calls.
Yeah. No doubt. That's always been my feeling, because the guys on the floor and the computers that you're up against, right? You're up against supercomputers that you really have no chance of beating, right?
Now, there I would disagree. I think that the problem with all the algorithmic trading is that it's trading by mathematicians rather than traders. And, periodically, they all get gutted and disemboweled by some some Six Sigma move that just wasn't really on their in their algorithm. So I think that's a pretty good edge, even for a day trader. When you look at a stock, the thing you want to be doing when you're actually scalp trading during the day is to trade outside of your comfort zone, to say, well, what is Mr. Market trying to get me to do here? And all you have to do is do the opposite. But the basic idea is that whenever you enter a trade, if you think, well, this feels good to me, that's the trade you don't want to take.
Yeah, because the market always seeks to frustrate and defeat the largest number of people, right?
Right. But believe me, if you bring just a little bit of intuition to the market, you can beat these mathematicians. They only know the market in a mathematical way. They don't understand market psychology. And, the best way to do that, how do you develop market instincts? Well, you simply come to the market every day with some disciplined system. And I have my own system. I teach it once a month in a webinar, but anything will work as long as it brings you to the market each day with a disciplined eye, where you're essentially dropping anchor in the same place to observe the market. And if you apply the same rules day in and day out, a rules-based system will eventually, it will become what you call horse sense in your brain.
Right.
You use the same rules every day to give you a disciplined approach to trading. You're going to find that the rules eventually become instincts.
Mm-hmm. Yeah. Yep. I've seen that in so many different areas. The people with the systems are the people that win in the long run. It's just definitely a truism. But you obviously need a system that's been proven over time and that's dynamic, that can change, because obviously, things change over time, right?
Right.
So that's important to make sure that it isn't a blind system that just tic-tac-toe. So getting started in it, though, that's like, where do you start? That's really my question with options.
Obviously, I'm going to say, come to Rick's Picks. My basic principle is to give my subscribers and students rods and reels and not fish. And you have to do the work, really. You've got to. One problem with learning how to trade is that a lot of people do it. They will get with a system that could work for them, and they'll be seduced by some other system that promises to make it easier. And I can tell you right now, it's never going to be so easy that you'll see some trading system out there that flashes a green light when you should buy and a red light when you should sell. It's always going to involve decision making, and for that reason, it will involve real work. But you have to stick with the discipline. You can't allow yourself to think, well, hey, I saw Larry Williams. He gave a nice talk the other day about this really fabulous trick that was making him lots of money. You can't. You can try that, but you have to stick with it. You have to give it time until it works.
Yeah, makes total sense. Anyway, Rick, just tell us where we find you and your offers to new subscribers.
RickAckerman.com. The name of the service is Rick's Picks. If you go to that homepage, RickAckerman.com, you'll see there's a 2-week free trial offer. And once you've taken the trial, I would suggest coming into the chat room, which runs round the clock. It draws great traders from around the world. They're a very helpful bunch. I would say the spirit of helpfulness and civility in that room is relatively high in the internet world. And I also put out some actionable touts each day. These are trading ideas. In some cases, they're very simple and specific. They're geared to beginners. And I also put out strategies for traders with more expertise. But I do try to put out enough that even beginners will be able to pay the cost of an annual subscription, and also to take the webinar that I offer on my what I call hidden pivot method.
All right. hidden pivot method, something I followed. It's pretty spot on. Rick, we'll talk to you soon. Hey, by the way, as always, you will find a link to Rick's site in the show notes to this interview. Make sure you sign up for our newsletter and check out the site while you're at it. Hundreds of articles per week from sources all over the place. No, not the mainstream financial press that's just out there touting the company line. We're trying to get to the truth, so you get the truth and figure out what to do to survive and thrive in the new economy. Anyway, Rick, we'll talk to you again soon. Thanks so much for being on.
Thank you, Kerry.
FSN Radio. It's all about what's next. Go to financialsurvivalnetwork.com and sign up for your free weekly newsletter. You'll also get 3 free reports. The Financial Survival Network. It's all about what's next.